I'm Garrett Cayet, SFMG's Chief Investment Officer. I want to quickly recap 2024 and touch on some of the items that we'll be focused on in the new year. So in the fourth quarter, the majority of the S&P 500's gains were achieved in November, and unsurprisingly were election-driven. Hopes for tax cuts and pro-growth policies helped push the index higher, ending the year with a modestly positive fourth quarter return, but an annual gain of over 20% for the second year in a row. Now, that said, the quarter didn't start off smoothly. In October, concerns about the U.S. election and the U.S. fiscal outlook weighed on investor sentiment, pushing treasury yields higher and stocks lower. And then in December, we got another dose of volatility. Although the Fed did cut interest rates again, they also scaled back their expectations for rate cuts in 2025 from 4 times to just 2 times. And that sparked a year-end sell-off that cut back some of those gains that were achieved in November. Now, as we step into 2025, there is a lot of optimism out there. Markets are focused on those prospective tax cuts, deregulation, continued economic stability, and more Fed interest rate cuts. Those factors fueled returns in 2024, but looking forward, there are still significant risks to consider. First, stocks look fairly expensive. With the S&P 500 trading at around 22 times forward earnings, these are valuations that are rarely seen outside of the late 90s tech boom or the post-COVID recovery where interest rates were near zero. So investors have been paying a premium, but going forward, these valuations will need to be justified with solid earnings growth. Next, although the U.S. has been experiencing steady growth, the economy could still slow as interest rates remain relatively high, and the full effects from that may still not have been fully realized yet. So the market may be underestimating the risk of a recession that could be caused by these higher interest rates. Politically, there are challenges too. With Republicans holding slim majorities in Congress, passing big tax cuts could face delays or complications. And tax cuts and fiscal spending pose issues for the bond markets as well. The continued increase of the national debt could cause treasury yields to rise unexpectedly, creating a headwind for stocks like we saw in 2022. And of course, trade tensions and tariffs add to all the uncertainty as well. So while our outlook for markets is positive as we start this new year, we're mindful of the overly concentrated areas of the market with valuations that we feel might be a little bit higher risk, and are focused on identifying opportunities where more reasonable valuations may provide a better risk-return trade-off. Thank you for listening, and if you have any questions about your portfolio, please feel free to reach out to your SFMG team. Thank you.